Welcome to Pie Uncut, where we break down the biggest stories in tech, business, and the stock market in a way that actually makes sense. Today's story is all about Tesla. One number is grabbing attention across Wall Street right now: 365,645 vehicles. That's the expected delivery number for Tesla in the first quarter of 2026. At first glance, it may seem like just another earnings metric, but in reality, this number could tell us everything about Tesla's future, its growth, its risks, and whether the company is still leading the electric vehicle revolution. Let's break it down in simple terms. Tesla has released a consensus estimate compiled from top analysts. The expectation is that Tesla will deliver around 365,645 vehicles in Q1 2026. Now, here's the important part. This number represents an increase compared to last year. Tesla delivered about 336,000 vehicles in the same quarter in 2025. So, on a year-over-year basis, Tesla is still growing. But there's another side to this story. Compared to the previous quarter, Q4 2025, Tesla delivered over 418,000 vehicles. That means this quarter is expected to show a decline of more than 12% sequentially. So which story is correct? Growth or slowdown? The answer is both. And that's exactly why this number matters so much. Let's understand the business behind these deliveries. Tesla's core revenue still comes from selling cars. Even though Elon Musk talks about AI, robotaxis, and humanoid robots, the reality is simple. Tesla is still primarily an electric vehicle company. That means deliveries are the most important metric investors track. If deliveries grow, revenue grows. If deliveries slow, everything else becomes uncertain. Now let's look deeper into what's driving this 365,000 number. Most of Tesla's deliveries come from just two models, the Model 3 and Model Y. Analysts expect these two alone to account for more than 350,000 units in this quarter. Other vehicles, like the Cybertruck, Model S, and Model X, contribute only a small portion. This tells us something very important. Tesla's growth is still heavily dependent on a narrow product lineup. That's both a strength and a weakness. It's a strength because Tesla has optimized production and scaled these models globally. But it's also a risk. If demand slows for these models, Tesla doesn't have many alternatives to offset that decline. Now let's talk about another critical piece of the puzzle: Tesla Energy. While most people focus on cars, Tesla's energy business is quietly growing. In Q1 2026, Tesla is expected to deploy around 14.4 gigawatt-hours of energy storage. That's a record level for the company. This includes products like megapacks and large-scale battery systems used by utilities. Why is this important? Because it shows Tesla is slowly diversifying beyond cars, and in the long term, energy could become a major revenue driver. Now let's shift to the stock market perspective. Tesla stock has been volatile recently. Some analysts are becoming cautious. There are concerns about slowing demand, increasing competition from companies like BYD and traditional automakers, and delays in new product launches. At the same time, Tesla is planning massive investments, around $20 billion in capital expenditure for 2026. That includes investments in AI infrastructure, factories, and possibly even semiconductor manufacturing. This creates a classic dilemma for investors. Tesla is spending aggressively for the future, but the returns from those investments may take years. And in today's market environment, investors are becoming less patient. They want results now, not promises. So where does that leave Tesla? Let's simplify this into three key takeaways. First, Tesla is still growing, but at a slower pace than before. Second, the company is transitioning from an EV leader to a broader AI and robotics company. And third, this transition comes with risks, especially if the core auto business starts to weaken. So what should investors watch next? The official delivery numbers. If Tesla beats the 365,000 estimate, it could signal strong demand and boost investor confidence. But if it misses, it could reinforce concerns about slowing growth. Beyond that, investors will closely watch updates on robotaxis, full self-driving technology, and Tesla's energy business, because those are the areas that could define Tesla's next phase. Now let's step back and look at the bigger picture. Tesla is at a crossroads. It's no longer just a fast-growing EV company. It's trying to become something much bigger. An AI platform, a robotics company, a technology ecosystem. But the transition is not guaranteed, and that's why every number, including this 365,645 delivery estimate, carries so much weight. Because behind that number is a bigger question. Is Tesla still leading the future, or is the market starting to move ahead of it? This is Pi Uncut, where we break down complex stories into simple insights. If you found this helpful, stay tuned, because the next phase of Tesla's journey could be one of the most important transformations in modern business history.